Is a reverse mortgage a good idea? You might be wondering if a reverse mortgage is a good idea for you, or maybe you have a parent that is considering using a reverse mortgage. For most people, when they hear the phrase reverse mortgage, they usually have one of two reactions. Either one, that sounds dangerous, or two, that sounds too good to be true. The reality is reverse mortgages are neither all good nor all bad. And like most financial tools, they can be very helpful in the right situation and harmful in the wrong one. What sometimes adds to the confusion here is that some financial advisors dislike reverse mortgages. Why is that? Some of this comes from outdated information and bad experiences from decades ago. So it's important to understand reverse mortgages, they used to be much riskier than they are today. Years ago, the fees were higher and there weren't a lot of consumer protections. And some products were aggressively sold to retirees who didn't fully understand them. Well, that created a lot of skepticism in the financial world, and honestly, some of that was deserved. But modern reverse mortgages are much more regulated today. The second reason financial advisors sometimes don't like reverse mortgages is misuse. A reverse mortgage is a tool, not a retirement plan. So if someone uses one simply because they're overspending, they've undersaved, or they're trying to maintain an unrealistic lifestyle, the reverse mortgage may only delay larger financial problems. Good advisors worry about people using home equity as a substitute for proper planning. Now, let's walk through the real pros and cons of reverse mortgages so you can better understand when they may and may not make sense. First, let's quickly define what a reverse mortgage actually is. This allows homeowners aged 62 and older to access equity from their home without having to make monthly mortgage payments. Instead of you paying the bank each month, the bank pays you, either monthly or in a lump sum. The loan is generally repaid later when either the home is sold, you move out permanently, or the last borrower passes away. Now let's talk about the advantages. One of the biggest benefits is flexibility. For retirees who have significant home equity but maybe limited cash flow, a reverse mortgage can create another source of income without forcing investments to be sold maybe during a bad market. That can actually help reduce what's called the sequence of returns risk in retirement. For example, if the market is down 20%, pulling money from a reverse mortgage line of credit instead of selling investments at depressed prices can help preserve your portfolio over time. Another potential benefit, the proceeds are generally tax-free because it's loan income, not earned income. And reverse mortgages can also help people stay in their home longer and cover healthcare expenses and create a cash reserve. And in most cases, it can actually be more efficient than liquidating highly appreciated investments and creating capital gains taxes. Now, let's talk about the drawbacks, because there absolutely are some. First, reverse mortgages are not free money. Interest accrues over time, which means the loan balance continues to grow, and that reduces the remaining home equity over the years. Second, depending on the specific offer, the fees could be substantial, so you want to make sure you understand the offer in front of you. There are often origination fees, mortgage insurance premiums, closing costs, and there might be some servicing fees. Third, you still have responsibilities as a homeowner. You have to continue paying property taxes, homeowners insurance, and obviously keeping the house up. So if those obligations aren't met, the loan can potentially go into default. And finally, reverse mortgages can reduce the inheritance left to heirs because the loan is repaid from the home value later. So, are reverse mortgages good or bad? The answer is simply, they're a tool. For the right person, they can create flexibility, improve retirement income planning, and help manage risk. For the wrong situation, the wrong people, they can create unnecessary costs and complexity. So the key is making sure the strategy fits into your bigger picture, your taxes, investments, income planning, healthcare, legacy goals, instead of looking at the reverse mortgage in isolation. So if you found this helpful, make sure to subscribe for more videos on retirement, taxes, investing, and financial planning. And if there's a financial topic you'd like us to cover in a future video, leave it in the comments below.